Right now, somewhere in like a massive climate-controlled server farm, a machine learning algorithm is deciding whether a total stranger will be able to afford fixing their transmission tomorrow morning.
Yeah, and the real kicker is that it's making that decision in a fraction of a second.
Exactly. And it's doing it without ever once looking at the person's credit score.
Right, which is wild to think about.
It really is. And if you spend any time scrolling online, especially late at night, you've almost certainly been targeted by the storefronts for these algorithms.
Oh, absolutely. You definitely know the ads.
Yeah, they flash on your screen, usually when you're already feeling, a bit of financial pressure. And they promise a $900 loan in California with no credit check.
Right, and it feels instantaneous, like incredibly convenient and almost suspiciously easy.
So easy. Which brings us to our mission for today's deep dive.
Hmm.
We are going to look at the actual machinery operating behind that promise of instant relief.
Because it really is a masterfully engineered piece of digital marketing. I mean, the framing is specifically designed to target a state of urgency.
Yeah, exactly. The ad isn't just selling a financial product.
No, it's selling immediate relief from a highly stressful situation.
And today, we're looking closely at EnableLoans and really the broader ecosystem of online lending marketplaces in general.
Right, and just to be clear, the goal here isn't to give you basic financial advice on whether you should click apply.
Right, no. We are investigating the back-end mechanics. We want to know how these matching algorithms actually function,
Yeah, like what a phrase like no credit check actually means when a computer is analyzing your life in real time.
Exactly. And how the underlying business model of these platforms dictates the offers you ultimately see on your screen. Because if you just look at the glossy interface on your phone...
You're missing the most important parts of the transaction. You're basically just looking at the storefront, but the actual product is being manufactured in the warehouse.
Well, let's walk right into that warehouse then. Because I was looking through the source material for this deep dive, and the very first thing that jumped out at me completely changes how you interact with a site like EnableLoans.
Oh, yeah. What was that?
Well, I always just assumed they were a digital bank. I assumed they had a ledger, an account with funds, and they were the ones deciding whether to wire you the money.
Ah, right. A lot of people think that.
But they aren't lending anything, are they?
No, not at all. They do not fund a single loan themselves.
Wow.
EnableLoans and, many platforms just like it are pure marketplaces. They're basically lead generators and connectors.
Okay, so they just sit in the middle.
Exactly. They sit right in the middle between you, the consumer looking for funds, and a massive network of third-party lending partners.
Right. And in EnableLoans' case, they advertise a network of over 350 independent lenders.
Yeah, 350.
So if I'm typing in my information, like my address, how much money I need, EnableLoans is basically acting like Tinder for debt.
Tinder for debt. That's actually a great way to put it.
Right. I build a profile,
Yeah.
and they just blast it out to 350 potential suitors to see who swipes right.
It is a very accurate way to think about it, yeah. But the swiping isn't happening manually, obviously, and it certainly isn't based on a casual glance.
I would hope not.
Right. It's a highly complex automated routing system. The real value proposition the platform offers to the consumer is just extreme efficiency.
Sure, because in the old days, you'd have to, manually seek out 10 different lenders?
Exactly. Fill out 10 different paper applications, wait days for a response. Here, you submit a single digital form, and the platform's API instantly pings that entire massive network.
But hold on, I'm stuck on the sheer volume here.
Okay.
Because if my application is being put in front of a network of 350 lenders simultaneously, doesn't that effectively guarantee a match?
You would think so, right?
Yeah, like if you knock on 350 doors, somebody is going to open one. It feels like the odds are overwhelmingly in the borrower's favor.
It definitely feels that way, but that assumes all 350 doors are equally accessible, and they aren't.
Oh, interesting.
Yeah, sheer volume does not equal a guaranteed approval. The reality is that your application is not actually being sent to every single lender in that network.
Wait, it's not?
No. The marketplace algorithm acts as, like, a sophisticated bouncer. It runs your data through a gauntlet of preset automated filters that are actually provided by the lenders themselves.
So the lenders tell EnableLoans ahead of time, hey, don't even bother showing us applications that look like X, Y, or Z.
Precisely. Lenders operate with very specific, constantly shifting risk tolerances.
Okay, that makes sense.
Yeah, so one lender might be looking to acquire conservative, low-risk loans this quarter. Another might be specializing in higher-risk, short-term microloans.
Right, but what if that second lender runs out of money?
That happens all the time. Their funding capacity for the week might be maxed out, so they temporarily drop out of the active matching pool. Yeah, so your single application is navigating all of these invisible real-time parameters. It's not 350 guaranteed open doors.
It's more like 350 locked doors.
Exactly. And your data profile is a very specific key trying to find the one tumbler it happens to fit perfectly.
Which brings up the specific details in the ads themselves. The one we keep referencing says $900 loan in California.
Right.
Is that $900 just bait, or is that a real figure someone can secure?
It's a real figure that a specific segment of borrowers can secure, sure. But it is heavily dependent on a strict set of criteria.
And the phrase in California is a big part of that.
It is perhaps the most important part of that entire advertisement.
I really wanted to ask about that.
Right.
Why is geography taking center stage in what is basically an online borderless transaction?
Well,
Because I get that a physical bank branch in Los Angeles only serves people in Los Angeles.
yeah.
But if I'm applying on my phone to an algorithm in the cloud, why does my zip code matter so much to the matching system?
Because lending in the United States is primarily regulated at the state level, each state has its own distinct financial codes.
Oh, okay.
Yeah, particularly when it comes to short-term or alternative lending. We're talking about state-specific usury laws, which cap the maximum allowable interest rate a lender can actually charge you.
So some states are stricter than others.
Oh, absolutely. Some states have incredibly strict caps, making certain high-interest loan products functionally illegal to offer to their residents.
Wow.
Meanwhile, other states have very permissive laws, and furthermore, lenders must be legally licensed to operate in the borrower's specific state.
Ah, so the algorithm is basically acting as a real-time compliance officer.
Exactly. If you apply from a living room in California, the system instantly cross-references your IP address and zip code against its database.
Okay.
If, say, 200 of those 350 lenders are not licensed in California, or if their loan products violate California's specific interest rate caps,
They're just gone.
poof, filter out in milliseconds. Your pool of potential matches just shrank by more than half before your financial data was even evaluated.
That makes the Tinder for debt metaphor even more accurate, honestly.
Yeah.
You're getting filtered out purely on distance and state lines before anyone even looks at your profile.
Yeah, exactly.
But let's look at what happens when an application actually makes it through that geographic filter and lands on a lender's desk. Or, well, lands in a lender's server.
Right, the server.
The ad loudly proclaims no credit check. And if I see that, my immediate assumption is that they're flying totally blind.
Right, that's what most people think.
Yeah, like they don't know my financial history. They aren't pulling my FICO score from Equifax or Experian. It feels like they're just taking my word for it.
Which would be a terrible business model.
Right. From a business perspective, how on earth is a lender assessing risk if they aren't checking credit? Are they just, hoping for the best?
They are absolutely not hoping for the best. No credit check is arguably the most misunderstood marketing phrase in the modern financial ecosystem.
Really?
Oh, yeah. It's a brilliant play on literal versus assumed meaning. The borrower assumes no credit check means no financial evaluation whatsoever.
That's definitely what it sounds like.
But literally, it only means the lender is bypassing the traditional credit bureaus. They just aren't looking at your 3-digit FICO score.
Okay, so if they aren't looking at the traditional score, what are they looking at? Because if I'm handing out $900 to a stranger, I want to know I'm getting it back.
Of course, they're relying on something called alternative data.
Alternative data?
Yeah, and in many ways, alternative data paints a far more intimate and immediate picture of your financial life than a traditional credit score ever could.
How so?
Well, when you go through a platform like this, you're often required to connect your actual checking account to the platform using open banking APIs.
Like Plaid.
Exactly, services like Plaid.
Wait, so I'm logging into my actual bank account through their portal?
Yes, you are. And by doing that, you're giving the lender's machine learning algorithm read-only access to your recent banking history.
Oh, wow.
The algorithm instantly scans the last 30, 60, or 90 days of your bank statements. And it isn't just looking at your overall balance.
What else is it looking at?
It's analyzing your cash flow velocity. It identifies recurring direct deposits to verify exactly how much you make and exactly when you get paid.
That is incredibly specific.
It really is. It scans for overdraft fees. It looks at your spending habits.
I see where this is going. Because the traditional credit score is almost like a historical document, right?
Exactly.
Like if I missed a few credit card payments 3 years ago because I lost my job, my FICO score is going to be terrible today, even if I've had a steady, well-paying job for the last 2 solid years.
Precisely. A traditional credit score evaluates your past. Alternative data evaluates your present.
That's a huge distinction.
It is. From a risk assessment standpoint for a short-term loan, a lender doesn't actually care what you did in 2023. They care intensely about what your cash flow looks like this coming Friday.
Right.
If their algorithm sees that a $1,500 direct deposit from an employer hits your account reliably every 2 weeks, and your rent payment goes out on the first of the month, leaving a nice buffer.
That's all they need to know.
Yeah, that real-time behavioral data is a massive indicator of your ability to repay a $900 loan in 14 days.
It's like a teacher standing up in front of the classroom and saying, hey, great news, there's no final exam this semester.
Right.
And everyone cheers. But then the teacher says, instead, I've tapped your phone and I'm going to grade you based on your daily homework, how often you show up to class on time, and every single note you pass in the hallway.
That is a perfect analogy. You are still being graded.
Yeah, the evaluation didn't disappear at all. It just became hyper-focused on your daily habits.
Exactly. You're trading historical scrutiny for real-time surveillance. The lender is essentially redefining what financial history means, tailoring it to the specific needs of their short-term lending model.
Wow. Okay, so we've established that the interface is incredibly smooth, the matching is instantaneous, and the data evaluation is lightning fast.
Yes.
Which brings us to a massive psychological factor here, because the entire ecosystem is designed for extreme speed and convenience.
Definitely.
And if you're having a financial emergency like your car is impounded or a medical bill is threatening to go to collections, you're likely in a state of high stress.
You're vulnerable.
Yeah, this platform feels like a frictionless life raft. But if these algorithms are smart enough to read thousands of lines of my bank statement in a second, they also know exactly how desperate I am.
You're right. Absolutely do.
So if the algorithm optimizes for the lender's profit, how does that translate to the actual offer that pops up on my phone?
This is where we really have to look at how dynamic pricing models work in alternative lending.
Okay, break that down for us.
Well, if an algorithm determines that you have a high cash flow velocity but very little margin, meaning money comes in, but it immediately goes out to pay bills, you represent a specific risk profile. In the traditional banking world, you might just get denied outright. But in this ecosystem, you might get approved, but at the absolute maximum annual percentage rate legally permissible in your state.
Ah, so they price the risk right into the loan.
Exactly. And they don't just rely on interest rates either.
Yeah.
This is where the friction they remove from the application process often comes back with a vengeance during the repayment process.
So,
You have to look closely at the mechanics of the fees, specifically origination fees.
I've always been a little hazy on how origination fees actually work in practice. It sounds like just a generic administrative charge.
It is essentially a fee the lender charges you simply for the privilege of them processing the loan.
Okay.
But the real danger is in how it's applied. Let's say you apply for a $1,000 loan and the lender charges a 10% origination fee.
Right.
You might assume you'll get $1,000 in your bank account and you just owe them $1,100.
Right. That feels like the logical math to me.
But often, the origination fee is actually deducted from the principal loan amount before the funds are ever dispersed to you.
Wait, really?
Yeah. So the lender approves you for a $1,000 loan. They take their $100 origination fee right off the top,
Okay.
and then they deposit $900 into your checking account. However, you are still paying interest on the full $1,000 principal.
Wow. So I asked for $1,000. I only received $900 to actually pay my bills, but my interest is compounding as if I have $1,000 of their money in my pocket.
Yes, that's exactly right.
That's wild.
And if you don't read the dense legal disclosures detailing how the funds are dispersed, you might end up $100 short of what you actually needed to fix your car while simultaneously carrying the debt burden of the full amount.
Yeah, you'd be totally stuck.
This is why the frictionless UI is so dangerous. It takes 3 seconds to swipe accept on your phone, but understanding the financial math behind that swipe requires you to stop, step back, and manually review the terms.
Which feels entirely counterintuitive when the platform is practically screaming at you to hurry up and get your cash.
Exactly. It's designed to keep you moving forward.
So if the deck is stacked like this, if the algorithms are constantly optimizing for the lender's maximum allowable yield based on real-time desperation signals, how does a regular person not get completely steamrolled?
It's tough.
If someone listening to this deep dive actually needs to use EnableLoans or a similar marketplace tomorrow, what is the defensive playbook?
Well, the first rule of the playbook is understanding that you are interacting with a system designed to maximize transaction value. Therefore, your goal must be to ruthlessly minimize your long-term exposure.
Okay, ruthlessly minimize exposure. How do we do that?
The most critical step beyond just looking at the APR is hunting down the prepayment penalty clauses in the fine print.
A prepayment penalty. That implies the lender is actually penalizing you for paying back the money early.
They are.
But why would a business be angry that you gave them their money back ahead of schedule? Doesn't that lower their risk?
It lowers their risk, sure, but it destroys their yield model. You really have to look at the business logic behind the loan.
Okay.
Many of these lenders package and sell these loans to investors based on an anticipated return. If they issue a loan with a 12-month repayment schedule at a high interest rate, they have modeled a very specific profit margin into their quarterly projections based on you making 12 payments.
So they are counting on that interest.
Exactly. If you get a bonus at work and pay off the entire loan in month 2, you have essentially denied them 10 months of expected interest revenue.
They aren't just lending you money. They are basically buying an income stream from you.
Yes. Beautifully put.
And if you shut off the stream early, they lose money.
Precisely. So to protect their yield, they institute a prepayment penalty. If you pay it off early, you get hit with a fee that recoups some of their lost interest.
That feels like a trap.
It is. If you are taking out a short-term, high-interest loan to bridge a temporary emergency, your #1 exit strategy should be to pay it off the absolute moment you're back on your feet. If the loan you're offered contains a heavy prepayment penalty, it effectively traps you in the debt for the full term. You must verify that you can exit the loan early without penalty before you ever click accept.
That makes total sense. You really need to ensure the fire escape actually opens from the inside.
Great way to think about it.
Now, there is one more trap I saw in the source materials that I really want to highlight, because I think it preys on human nature perfectly.
Oh, the upsize trap.
Yes, the temptation of the counteroffer. Let's say my transmission repair costs exactly $900. I put my application into the marketplace, the algorithm does its thing, and a lender comes back and says, "Congratulations. Based on your robust cash flow and direct deposit history, you are actually approved for $1,500.
Right.
I can tell you right now, the immediate human reaction is, amazing. I'll take the $1,500, I'll pay the mechanic the $900, and I'll have $600 left over to buy groceries, fill up the gas tank, and maybe get ahead on a utility bill."
It feels like you just won a mini lottery.
Exactly. It feels like a win.
And that is exactly how a short-term emergency fix permanently spirals into long-term financial distress.
Because you borrowed more than you needed.
Because of the mechanics we just discussed. The lender is not offering you $1,500 out of generosity or because they think you deserve a break.
Right. They aren't your friend.
Not at all. They're offering you $1,500 because their algorithm calculated that this is the absolute maximum amount of debt you can theoretically service before you default.
Wow.
They are optimizing for the largest possible principal balance they can extract interest from based on your specific income.
They're maximizing their product size. Just like a fast food restaurant, asking if you want to upsize your meal.
Yes, but the cost of this upsize compounds weekly. Borrowing more than your immediate emergency requires means you are paying exorbitant interest rates on discretionary money.
Which you never would have borrowed otherwise.
Exactly. Making an informed decision in this ecosystem is entirely about taking control back from the automated platform.
So what's the move?
The marketplace wants to facilitate the largest transaction it can safely underwrite. Your defensive strategy must be surgical. You borrow the exact dollar amount required to resolve the immediate crisis.
Right.
You ensure there are no origination fees secretly eating into that principal. You verify you can pay it off early without a penalty. And then you close the transaction.
It really is a battle between your discipline and the algorithm's optimization.
It absolutely is.
Well, we have covered incredibly dense territory today. I mean, we started at a simple late-night advertisement for a $900 loan, and we walked all the way into the warehouse.
We saw the whole assembly line.
We really did. We saw the matching algorithms, the state-level compliance filters, the open banking APIs analyzing your real-time cash flow, and those dynamic pricing models calculating origination fees and prepayment penalties.
It's a lot of machinery moving very fast.
It is. And can a marketplace like EnableLoans act as a bridge during a legitimate financial crisis? Yes, I think we've seen that the technology successfully connects borrowers with capital at unprecedented speeds.
It does work.
But the absolute core takeaway here is that speed is not a substitute for comprehension. When the friction is removed from the application process, all of that friction is simply pushed onto the repayment process.
Perfectly said.
You have to slow down, read the mechanics of the loan, and understand exactly how the lender is extracting their profit.
Because the interface is designed to make you feel like the algorithm is taking care of you. But the algorithm is only taking care of the transaction. You are the only one who can actually protect your future cash flow.
Such an important point. And I want to leave you with one final thought to ponder. We just spent a significant amount of time detailing the genuinely astonishing technology powering these platforms.
It's really incredible tech.
We're talking about cloud-based systems that can instantly cross-reference your IP address with state usury laws, ingest 90 days of your raw banking data, identify your employer's direct deposit schedule, assess your risk profile, calculate and optimize dynamic interest rate, and generate a customized loan offer.
And all in the time it takes you to blink.
Right. So if the financial industry possesses the technological brilliance to analyze thousands of data points in a millisecond to protect their investment, why hasn't that exact same incredible technology been utilized to translate their dense 30-page legal disclosures and hidden fee structures into something simple, transparent, and equally easy for the borrower to read?
It really makes you wonder what the technology is actually designed to optimize, doesn't it?
It really does. Something to keep in mind the next time a frictionless solution pops up on your feed. Thank you for joining us as we explore the hidden mechanics of online lending marketplaces. We hope this deep dive gives you a clearer lens to view the financial machinery operating behind the screen. We'll be back soon to investigate another complex system. Until then, stay curious and always read the fine print.